Hi everyone, it's Alex here at Sestry Capital Research. Welcome to our Growth Investor Pro weekly webinar, currently Thursday the 25th of July, just after 4:15 Eastern for the benefit of the tape. Okay, today I wanted to cover really one topic, which is hedging. So this is a word that's a lot used, little understood, and even little practiced. And it's something which is a great method which can help to manage risk, limit losses, and sometimes even make some money as well when markets sell off as they are at the moment. So I wanted to talk through it. And we can go in any level of sophistication you like. I can't promise to be able to answer everything, but I'll do my best. And we'll start light and we'll go from there. If there's time, we'll run through equity indices as well, take a look at the VIX, probably one or two other things. And as always, we'll do live Q&A. So if you have questions, comments, things you agree with, disagree with, anything at all, shout. And the way to make yourself heard is either in a moment I'll open mic, so you can just shout into the system with the mic open. Alternatively, you can post comments and questions in the webinar platform itself, or you can use the chat room in Rocket Chat in the normal way, and I can read out those questions and share them with the group. Before we do any of that, let's take a look at our disclaimer, which is currently on your screen. So, disclaimer, this webinar is intended for US recipients only, and in particular, it's not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestry Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestry Capital Research. Sestry Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's get mics switched on. We're here. Okay, mics are on. Okay, so let's talk about hedging. Now, to talk about hedging, the first thing we have to do is we have to talk about stock charts, which, as everyone knows, it's a fascinating topic. So let's get something on your screen right now. Okay, so this is a chart that will be familiar to you from endless episodes of this webinar. This is a monthly chart. It's the S&P as represented by the SPY ETF, and it shows the chart from the March 2020 bottom. If you're going to manage risk, the first thing you have to do is to work out roughly when markets might change direction. And so let's assume, for the sake of argument, that one is a naturally long investor. In other words, most of the time, whether you're managing a fund or other people's money on an advisory basis, or you're running your own money, let's assume that for the most part, you are invested so that if markets go up, your account grows. And let's use that as the dominant model for today. So when I talk about hedging, I'm going to mean protecting the downside, and downside I'm going to mean when securities go down in price, because for most people are trying to make money when securities go up in price and protect themselves when they go down in price. So to have an idea about when markets are going to change direction, the only way to do it, in my opinion, is some form of technical analysis, meaning charts, price charts, volume charts. I don't believe you can do it with any degree of reliability by reading the news or by looking at fundamentals, be they company fundamentals or index level fundamentals. You know, the PE at which the S&P 500 is trading doesn't tell you anything about a possible change in direction. Politics doesn't tell you anything about a possible change in direction. This all just noises off. The only facts of the matter are the price and the volume. Now, the reason that we use charts so extensively in this service is that to within a reasonable degree of accuracy, there are patterns that overlay charts that can help you work out where price might move next. And of course, all these things are maybes, probabilities, they're never definite. but they can help you try to anticipate a change in direction. They're a little bit like road signs, or if you see, if you're driving and the curve starts to tighten, you know that it might continue to tighten further, and you know to be ready to turn into the curve to manage your speed, manage your angle of the steering wheel, all of those things. You're looking for signs, indicators the whole time as to anticipate the price movement. And there's many ways to do that, and you'll see endless amounts of technical analysis methods out there. The method we use in this service and elsewhere in our work, and for me personally, I use it for my own personal investing and trading, is the Elliott wave and Fibonacci system. And the reason that I use it is very simple, which is it's used in institutional investing and trading. And the evidence of that is the degree to which the levels it prescribes are hit. Now, of course, nothing is perfect, but it happens a lot more than coincidence that sell-offs stop at a level which would be typical within the system, and bull runs stop at a level which would be typical in the system. I'll give you a really simple example here. So again, this is the monthly SPY chart, and we're going to measure from the bottom of the COVID crisis to the top of the 2021 bull market, and then down to the bottom of the 2022 bear market. Now the S&P stopped selling off at exactly the 50% so-called retracement of the move up from the COVID low to the bull market high. In other words, it drops half of the value that it's created in this time. And typically a sell-off will happen faster than a bull run. So here, this was March 2020 to January 22. So what's that, 22 months-ish? And it shed half of that value in 9 months. So sell-offs, you'll see people refer to sell-offs being down an elevator, and bull markets being up the stairs or up the escalator. And that's typical. Now, how would you have known where the S&P would stop selling off? Well, you can't ever be certain, but what you would be looking at is the following. Just clean this up a bit. You would be saying, well, I'm pretty sure that the S&P is not going to revisit the COVID lows, because why would it? We had this massive monetary stimulus here, a one-time, once in a generation event that led to the stimulus. And, as time passed in 2020 and 2021, the medical threat of the event began to fade with preventative measures, vaccines, and post-virals and whatnot. And although we were left with an inflationary impulse from all of the monetary and fiscal stimulus, the economy started to do okay, and a lot of the spare money had gone into risk assets and was likely to continue to stay in risk assets. So there was no particular reason to suppose that once this bull market high was hit here, the COVID lows were going to get revisited. Now, I know that, if you went all over Twitter at the time, they'd tell you that, the S&P was going to zero, but that's best ignored. What you would have done is you would have said in this system, well, look, it's unlikely, you would say, that the S&P would find support at the first. Let's make these bars a bit thicker. You would say it's unlikely to find support at the first rung down of the ladder. First rung down on a retracement is the 23.6. You'd say, well, it might find support at the 38.2, but probably not. And you can see it thought about it. Okay, so here's the 38.2 retrace. Here it hit it in May 22, held support. Bounced off it in June, retested it, sort of held support again in July, was above it in August. And it took till September and then to break it. It moved up again in October, thought about holding above, finally pushed down and found support at the 0.5. So the 236, you can see it tried to hold that in January, February, March, even April, failed. Tried to hold the 38.2 in May, June, July, August, finally fell in September. It held over the 0.5 in September. It touched the 0.5 in October and it moved up. So you might have said, well, this 0.5 here is a bit above, where support could be held. You would say that in this pattern recognition system, it could be that the S&P falls as low as the 61.8 retrace or the 78.6. How you would know that it hadn't is if you were to zoom in on a more detailed time frame. So if you were to look at the weekly or the daily, so if we can get this here, I'm just going to switch to trading view. This is 2022 here. This here is the low that was struck, 13th of October. And this was about that 0.5 retrace we were just looking at. And you would be watching the S&P each day, each week, and you'd say, well, this is a move up from here. This was a local low. Here's a move up. Here's a retrace down. Well, it hasn't made new lows. It's made higher lows. So you would say, I feel pretty good about that being the low. Now, markets being markets, what you actually got was a spike low here. This is the S&P, a spike low, a test of any sellers down here, there weren't, and then basically a scalded cat move up. So going back to the monthly on the S&P, I'll get back to hedging in a moment, you'll see where I'm going with this. Then you could have said, okay, I now have a system whereby I can measure retracements, sort of down moves, and now I need a system where I can measure up moves, and I need to know where an up move might finish. Well, in this system, Fibonacci and Elliott wave system, we use Fibonacci extensions to look at up moves. This is back to the S&P monthly, and the reason that we have price targets on the things we cover is because we use the up move typical pattern recognition system to say, well, where could it go to? So forget what one's opinion is, but in the pattern recognition system, it's possible that the S&P in the SPY form reaches 837. That's a 1.618 extension of this wave one here. What does that mean? It means you take the share price movement here, so you take 480 minus, let's call it 220, so it's a $260 move, multiply by 1.618 and place it at that wave two low. A less ambitious target would be the 100% extension, which is to say you take the same share price move that was put in here, let's call it 260, you place that at the wave two low here, and off you go again. So this wave three will be the same length as the wave one. Now, armed with that, you can say, well, as this security here, let's forget what it is, approaches one of these targets, I know to be careful. I know to stop thinking it's going to go up forever, whatever my brain might tell me, and I know to be a little bit careful. This is the essence of technical analysis, which is to say, learning some road signs as to when markets in decline might find support and when markets in a bull move might find resistance. And you would layer on a volume tool. As you know, we use this volume by price tool. And what that does is it tells us, well, at any given time, let me just grab the clock here. At any given time, is there a big spike in volume or not? It turns out, funny enough, that nobody was buying the COVID low, interestingly, and that's because nobody really sold it. Despite March was a big candle, but apart from that, it was mainly retail selling. There was a lot of activity here. Very specifically, if we drag the clock to, let's start at around April 2022, look at this, look at the buying here, right? So This would also have told you that from around April, May of 2022, all the way through the year, there was big accumulation. And so when you saw a spike low down here, but you know there'd been big buying up here, you again would think, well, there's a good chance that's a low, off we go. So as we approach a high, be it a local high or a long-term high, you know to be careful. Now, you know that in the service we've been saying for a long time, just be careful of a Q3 sell-off seasonally. July down through September into October can be weak. And we've said this repeatedly that it can be a tricky time. And so it's turned out to be. So let's look at SPY. Let's look at it on the daily, and then let's look in recent days. Now, the first thing to note is that compared to anything on the long-term chart, the current sell-off is no big deal, as can be seen. But it doesn't feel like that. Sell-offs always feel like a really big deal. Here's a couple in recent history. So here is Q3 2023. This was the high in July at 460, let's call it. And this was the low in November at 410. It's not such a big deal in the grand scheme of things, except at the time, which is when it feels like a really big deal. So if we were to measure that price range, that's about an 11% drop-ish. From peak to trough, about 11%. And it took place over 27th of July down to 27th of October. It's almost exactly 3 months. And it didn't go straight down. It went down, up, down, up, down. And that's pretty common. That's a so-called impulsive sell-off. And it's made up of 5 waves. 1, 2, 3, 4, 5. I can hear Fred screaming at me for this 4 breaching the 1, but we're just going to run with it for now. That's Q3 last year. And then it hit the low, and then boom, off we go. Now, how would you know that there was the low? Well, you could measure it. So you would say, I'll measure that reach. Here we have a wave 1 down, so the 2 is a retracement back up there. 3 is an extension of that 1. 4 is a retracement to that 3, and 5 is an extension of the 1 and the 3. And if you apply standard pattern recognition, roughly where a wave 5 might end. Not always, not definitely, but roughly where it might be. And then you'd see this V-shaped recovery, and when sell-offs reverse, they tend to do this in a rapid fire fashion. Tops tend to be more gentle processes, tend to take a while, retest the top and so on. Bottoms tend to be bang, bang, straight back up again. We then run in pretty much a straight line all the way to the 1st of April this year down to April the 19th. And here's this next sell-off here. And this is a smaller one, about 6%, and it took place between 1st of April and 19th, 2 weeks, let's call it, 3 weeks. Now we go up in a pretty much straight line to now, and here's the sell-off that we're currently engaged in. And so far, it's been about, in the S&P, about a 5% drop, so not that much. From the high on the 16th of July to the low so far today, the 25th. If we look at the NASDAQ, sell-off's been more brutal in the NASDAQ. This is QQQ on the daily. And if we were to look at the top to bottom so far, it's about 9% in the NASDAQ so far. So Q3 sell-off in the NASDAQ right now has been pretty similar to Q3 last year. So this is the NASDAQ in QQQ form. Sold off 12% last year. So if this year is like last year, we're about, 3/4 of the way through. Okay, so having taught yourself some sort of method to measure where moves might start and finish, how do you protect yourself? Well, There's a couple of ways. You can either do nothing, and if you own indices, if you own the S&P, if you own the Nasdaq, then all of history to date says, well, these markets only go up. If you just wait, markets just go up. And this is the origin of the Warren Buffett DCA dollar cost averaging strategy, which says just put some money into the S&P every month, every quarter, and don't ever sell. Sell when you retire or just before you die, basically. And history says that that has been a great strategy. And it relies on the fact that the US economy has only gone up over a long period of time. Demographics have helped that. Economic output has helped that. Monetary policy has helped that. Blah blah blah. New highs are made all the time in the S&P, and that's a perfectly good strategy for the long term. Nothing wrong with it at all. If you want to try to protect your account against drawdowns, because either one, well, it would be nice not to suffer the drawdowns, obviously. Two, perhaps it's money you need. So in the Buffett model, the theoretical investor doesn't need the money tomorrow. So if the investor is an individual, this isn't money they need to spend in any conceivable time frame. And if it's a fund with a very understanding set of investors that don't mind brutal drawdowns every now and then. And I'm not sure which fund that is. I'm sure it exists, but most funds get a world of pain from their investors whenever they sell off. And what investors say to those funds is, well, did you not think to hedge or protect or go to cash or something? So how do you protect? Well, if you in this system have seen a 5-wave move up, and I don't mean over a 3-minute period, but over a period of weeks or months, then you can think, well, things are getting a bit toppy. If you know that seasonally, Q3 tends to be weak, in an election year, we talked about all this in recent weeks, in an election year, it tends to be a bit risk off into the election and risk on after the election, regardless of who wins these things. And so you might be ready to say, well, I think I'll just be a bit careful up here. What do you do? Well, option one is, just go to cash. So sell all the index you own or some of it and just hold more cash in your account than you did before. Wait, measure the sell-off. Don't just guess when it's finishing selling off, but measure it. Watch these retracements. We go through them every week on this webinar. And on our website, there's something called a market on open note that will give you this daily if you want it. We measure this all the time. And when a sell-off gets to a level where it might reverse, then you can sit, wait, watch to see if it reverses or not, and you'll know if price reverses because it's going up again. And at that point, you could redeploy your cash. And that's the simplest form of hedging, which is take the capital out of a security, put it in cash, wait, redeploy it lower. Very good strategy. All you need to do is know how to use charts like this. You need to get good at charts. This isn't easy, but nothing's easy if you want to make money. Obviously, if it was easy, everybody could do it. But it is anyone half sensible that's half numerate can do this with practice. What about hedging though? Okay, there's lots of ways to hedge. You can use options. You can use all manner of things. But today I'm going to talk about inverse ETFs because they're the easiest, most liquid, easiest to understand. If you own, in this case, QQQ, so this is a simple so-called unleveraged long ETF. So if the Nasdaq index goes up 1% today, then QQQ, the ETF, should go up also 1%. If the Nasdaq index falls 0.5% tomorrow, QQQ should go down about 0.5% tomorrow, more or less. So it should follow the index pretty closely. The QQQ tracks, by the way, the Nasdaq 100, not the Nasdaq Composite. So that's important. It's the bigger stocks. QQQ is one of the most liquid ETFs out there. It trades 24 hours on Interactive Brokers, a bit less on other brokers. It is a very, very, very liquid instrument. It's institutionally traded. That's important because it means it respects technical trading levels. It's a really, really good ETF. The same is true for SPY. It has an inverse. In the case of QQQ, the inverse is P for Peter, S for sugar, Q for quotient, PSQ. PSQ, if the Nasdaq 100 goes up 1% today, PSQ will go down 1%. If the Nasdaq index falls by 0.5% tomorrow, PSQ should be up by 0.5% tomorrow. And if you own QQQ and PSQ in equal measure, then whatever the market does, your account pretty much won't move. Might be a bit of noise here and there at the edges, but pretty much it won't move. So on a 1% up day, your QQQ will go up 1%, your PSQ will go down 1%. Now in a bull market, that's bad. Owning PSQ, bad idea. Why? Because as we've said, US equity indices tend to only go up over time. So owning a large inverse ETF for a long period of time can be a really damaging thing. You just end up with compounding losses. But owning for a short period of time, and that could be a day, a week, a month, 6 months, a year, however long the sell-off lasts, can be a really good thing. Let's say you executed perfectly, and at the top, very top of the Nasdaq here on the 11th of July, you said, well, look, I think this thing's going to sell off. I own, let's say, 100 units of QQQ, whatever that is. It could be 100 shares, or it could be $10 billion of QQQ. Doesn't matter what it is. I own 100 units of QQQ, and I'm going to hedge myself perfectly. So I'm going to buy 100 units of PSQ, meaning the same capital value in PSQ as you own in QQQ. So in the event you own $10,000 of QQQ, you'd buy $10,000 of PSQ. If you own $1 billion of QQQ, you'd buy $1 billion of PSQ. Doesn't matter the amount. So what you're looking at is the hedging ratio. When you see me refer to ratios in disclosure alerts, I'm always referring to the capital ratio. So how much capital is at work? If I say 2 to 1, there is twice the amount of capital on the one side compared to the other. 3 to 1, 3 times compared to the other. So a perfect hedge, if you were brilliant, up here, you'd say, okay, 1 to 1, QQQ to PSQ. And then you'd say, because, again, you're the perfect trader, I'm going to just wait. And I'm going to wait till the sell-off's finished, and I'm going to measure it. And when I know that it's finished, and I'm a perfect trader, so I'm going to call this to the dollar, then what I'm going to do is I'm going to sell my PSQ. And let's say there's been a 10% drop. So, and I had 100 units of PSQ up here. The Nasdaq has dropped 10%. Let's just ignore daily compounding for a moment. We can get into that if you like. Let's ignore it for now. My PSQ is now worth 10% more than I paid for it. So I now have 110 units of PSQ. Well, I'm going to sell that. And now I've got 110 units of cash. I used 100 units of cash to buy PSQ. Now I've got 110 units of cash. So some free money has landed in my lap from the market gods. I've now got 10 units of free money. Now, by the way, my QQQ has also declined by 10%. But I know, because I'm the perfect trader, that the market's going to go up tomorrow. I've got 10 units of free money, and I'm going to use that to buy me some more QQQ at these lows. And this is a form of compounding. Basically, hold the long leg, essentially forever. Think of it like the Warren Buffett model. And when a sell-off comes along, buy the short leg, wait for it to sell off, wait for the market to sell off, cash in the short leg, take the profit you made, which is free money that you wouldn't have had otherwise, and use that to add more allocation to the long leg. That basically is a sort of a supercharged version of the Buffett DCA model, because it's not just that you're putting cash in from some other source. The market has given you money for nothing because you were cute enough to hedge on the way down. Now, if you want to get more aggressive, again, let's say you're the perfect trader, you could say, well, I'm up here, I've got my QQQ. I don't want to sell it because this is in a taxable account. If I sell it, I'll incur a tax charge. And also then I'm going to have to buy it back again at some point, and that's a lot of decisions to make. So I'm just going to hold it. But I think this market's going to sell off a lot. So I'm going to overhedge. I'm going to buy 2 units of PSQ for any 1 unit of QQQ. Now, as we said before, I've got 100 units of QQQ. So I'm now going to buy 200 units of PSQ. Why? Well, I'm really sure the market's going to sell off, and I'm a perfect trader, so I can rely on that. I've got my measurement system. I know when this has ended because I can measure it perfectly because I'm the perfect trader. So as this drops 10%, then again, ignoring daily compounding, my 200 units of PSQ will now have turned into 220 units of PSQ. My 100 units of QQQ will have dropped to, I'm going to say 90 units, just use round numbers, 90 units of QQQ. I've got 220 units of PSQ. I'm going to sell it. I use 200 units of cash to buy PSQ, and I've got 20 units of cash left, free money that the market gods have given me. And I'm going to use all that to buy more QQQ. So now I've got 110 units of QQQ down here, and that's a price here. I had 100 units of QQQ up here, so I've got more capital at work at a lower price than here, simply because I overhedged. and the market gods gave me 20 units of free money to reinvest at the lows. Now, if you can get good at this, the hedging and over hedging model, that is a superb method of compounding. It is difficult, okay, because no one's a perfect trader, no one's measurement system works perfectly, but this is nothing other than a sport. It's a video game, and as we all know, with real sports or video sports, the more you practice, the better you get at it. There isn't any secret magic formula. There is no course you can subscribe to that will give you the hidden algorithm. I haven't never yet seen a computer program that will do this for you. Perhaps it exists, but I haven't seen it. The way to do this is to spend time at the screen and to practice the charting methods. And this is something that, again, anyone half numerate can get good at. You don't need to be, any kind of financial analyst to do this. You need to be able to count to five. You need to be able to recognize the difference between a 5-wave and a 3-wave, and you need to be able to measure using these retracement and these extension tools, or use some other technical method. Doesn't matter. Any pattern recognition system that works for you, use it. You want one that tells you roughly when things are topping out and roughly when things are bottoming out. And the other thing that I think is really important is you have to have the confidence of your own judgment. So when markets are at their lows, let's go back to that monthly SPY chart. If you went back and looked at the financial media around this time in Q3 2022, it basically was full of doom, okay? The world was going to end. The COVID lows were going to get revisited and broken through down to the downside. Inflation was going to keep rising forever. Inflation was going to be 15%, and 101 other things. And you have to ignore that, or in fact use it to your advantage, because what you have to realize is that the euphoria at the top of a bull market is complete garbage and nonsense that is designed to suck in, idiots and take the money off them. And the misery at the bottom of the bear market is garbage and nonsense, and that's designed to suck in idiots and take the shares off them for not very much. It is there to mislead you, and it's best ignored. Best way to trade and invest, in my opinion, is just switch the news off. Don't read it. Don't even think about it. It doesn't matter what the Fed's doing. Nothing matters. The only thing that matters is the price and the volume in front of you. That is the essence of hedging. So you see me post these disclosures all the time. I appreciate it can get a bit fast and furious and confusing. Some people use it, some people don't. But I think if you're serious about investing and trading, you sort of owe it to yourself to learn how to hedge. Now, be that hedging by just going to cash and being confident enough to do that. That's really easy. Anyone can do it. You have to resist the urge to dive back in the market 10 minutes later. You have to have the confidence to go to cash when markets are raging and everyone around you is telling you to go and buy 4 times leveraged NVIDIA ETFs. You have to have the confidence of your judgment. But anyone can do that. And the next step is to hedge 1-to-1 using some of these inverse ETFs. And then if you get really good, really confident, successful, over hedging, so you're actively making money on the downswing, is the next step. Right, I'm going to stop and take questions, because this is a topic which we always get a ton of questions on. So please do ask away. Let's open mics and any questions you have, comments, fire away. Over to you. Abby, you're on.
Hi, Alex.
Hey,
Quick question. So, what is your typical holding duration for your levered shorts?
my holding duration.
Yeah,
Um,
typical
well,
typical holding duration, because as you said that if you hold them for very long, yeah, the value by itself will go down. So,
yeah.
just wanted to get an idea there.
Well, the first thing to say is, as anyone here may have noticed, I'm not the perfect trader. And so my error with shorts, which I'll declare now, is I tend to sell them too soon. And the reason I tend to sell them too soon is because I'm really scared of getting shorts trapped underwater as the market rips to the upside, because this is a really common error where the more bearish the market gets, the more one's mind works to convince you that it's going to keep getting bearish, and the more you pile on short exposure. And as I mentioned earlier, when reversals happen from down to up, they tend not to be gentle. Up to down tend to be quite gentle. Down to up tend to be vicious and just reverse in a V shape. And very often in the indices, when you see a reversal, I mean, look at this low in September 22, it was never revisited. So if you'd shorted down here, you just lost money from now and from then until now. So my own holding period tends to be until I think there's about to be a reversal. And this is error prone. I mean, I did it today, right? So I had a large SQQQ position. I sold it this morning. That was a bit soon, not too bad, a bit soon. And I thought, oops, made a mistake here. And then I bought a new SQQQ position, held it for a while when it went up, and then sold it again. Imperfect execution, but overall meant, I banked some really nice profits from SQQQ in the last week or so, and then a little bit of extra profit from the new position I opened and closed briefly this morning. So I personally tend to be a bit nervous holding shorts, particularly in a bull market. So if you look at the current correction, I don't think personally that what we're seeing now is, I don't think it's the start of a bear market. I don't think it's, the end of days. I think it's a correction. I mean, so far we've had a 9% correction in the Nasdaq, no big deal, right? In the S&P, we've had a 5% correction, no big deal. So far, it's less of a correction than Q3 last year, no big deal. This is just a correction. So I get spooked holding a short too long, because an index long, this isn't true for random stock X, but an index long in the S&P or the Nasdaq and the Dow, thus far in all of history, you just have to hold it for long enough and it will go up. So if you bought a long position at the wrong time in the S&P, the Nasdaq or the Dow, then thus far all you needed to do was wait and it would come back into value. And you might choose to average down, you might choose to do lots of things, but so far if you just waited, it would come back into value. That's not true for shorts. Shorts can end up costing you a lot of money. And my own personal view is, in a bull market, which we're in, I'm careful with them. Now, at some point, we'll be in a bear market. When that is, I don't know. I don't think it's today. And at that point, you have to stand the logic on its head and say, well, the dominant thing I'm going to own is an inverse ETF. Now, that's the thing that I'm going to not stress about. That's going to be making money every day or most days while I sleep. When the market reverses upwards, I'll hedge with a long ETF and do the exact opposite of what I just said a minute ago, which is when the market goes up in a bear market, try and catch that with a long ETF and sell that for profit before resuming the downslope. So in a bull market, I tend to be nervous of shorts. In a bear market, I'd be very indulgent of shorts, which is a long answer, but my holding period, really varies. It might be from a few minutes if I've made a mistake, to a few days, to a few weeks. I tend to be, if you look at the trade disclosures, I tend to be a bit jumpy with shorts, a bit too jumpy, actually. So in a case of do as I say, not as I do, if you were to criticize the trades you see posted in disclosures, it's they're a bit jumpy with shorts.
Thank you.
Good question, thank you. Who's next? Ross, you're on.
Hey, Alex.
Hey,
Yeah, general question about the charts, and that is the volume bars on the right-hand side.
yeah,
Whether it's TrendSpider or TradingView or however many others there might be out there. So the chart you have up right now, the bars read all gray. We can look at the waves and see and make a pretty educated guess as to whether that's buying or selling for the most part. But what my question is with as sophisticated as these things can be, with all the different things you can do and plug in and everything else with these charts, why can't they show on any given bar the percentage of buys and sells in terms of the volume?
be,
I've always wondered that.
because large funds do absolutely everything they can to disguise that information. That's the answer. Because you're right. The interpretation here is you have to use your judgment to say, well, if this is moving sideways down here, is that predominantly buying or selling? And I used to get myself a bit tied up in knots about this, thinking, well, if there's a buy, there's a sell. What's the difference? But because your question is who's buying and who's selling. Okay, if you know BlackRock is buying and the kid at the bus stop is selling, then probably you want to be doing what BlackRock is doing, not the kid at the bus stop. If the kid at the bus stop is buying and BlackRock is selling, again, you probably want to be selling. The difficulty is that if you are a really large account manager, if you manage truly large amounts of money, anything you do gets picked up somewhere. And so, when one of these accounts places a trade, they'll break that trade up into as many tiny blocks as they can, and they'll trade it all over the place in, 20 different venues, dark pools, internal liquidity pools, God knows where. Because the one thing they don't want you to do is to work out what they're doing. And so the answer is that you're fighting, your opponent is trying to prevent you seeing what they're doing. So you have to use interpretation. Now, there are some other tools you can use to look at this. So there's a method called depth of market or order flow. And so software companies, there's one called Ninja Trader, I think, and there's a couple of others. They'll show you in real time where the bids are coming in for a particular security at a particular price at a particular time of day. And again, that gives you another level of interpretation as to what's going on. That's pretty useful if you're sort of actively trading intraday. It's not all that useful, in my opinion, if you're investing or trading over a period of weeks, months, years. But intraday, it can be pretty good. You have to really learn to use those things. They look a bit like stock charts, but they're not like stock charts. What they're telling you is where is the preponderance of buying and selling. Buying tends to be the lows, selling tends to be the highs. And so the next level of sophistication is depth of market or order flow analysis. And that's a really great tool. But to take advantage of that, you've got to be deep in the rabbit hole and pretty much do this all day, every day, and not much else. It's hard to use if you have something else to do in the day.
Sure. Yeah. Okay. Well, that's a great explanation.
Good. It's a very good question. And the main reason is because the big people don't want you to know what they're doing.
Right. Okay. Thanks a lot.
Right. And this whole method is breadcrumbs, right? The whole time you're trying to find the breadcrumb. You're trying to work out what it is. What is Larry Fink doing? Well, I want to do some of that. I don't want to do what the kid at the bus stop is doing. I don't want to be Chad. I want to be Larry Fink. That's the whole point of technical analysis.
Right. Yeah. Wonderful. Thanks a lot.
Welcome. Ron, you're on.
Alex?
Hey, Ron. Hey, how you doing?
Yeah, I'm good. I'm good. This has certainly been exciting.
No, I don't think so, unless it's a very slow day.
I love these sayings and that we have in stock market trading, which, as far as I know, are unique to stock market trading. One of my favorites is the trend is your friend.
Absolutely.
I'm sure you've heard that one. And then a good one from Warren Buffett is risk comes from not knowing what you're doing.
Yeah. That's very true. I haven't heard that one actually, but that's very, very good. Yeah.
So two slogans that I think I need to remember that you said today. One is downtrends to uptrend reversals are vicious, and the second one is uptrends to downtrends tend to be gentle.
Yeah.
So if I try to implement the techniques that you're talking about, and for example, now we're in a bull market, but we're having a temporary downtrend. And if I assume that the reversal will will be vicious or faster than this downtrend which has occurred. How how do I know when it's safe to buy back into the uptrend
Yeah,
and to get rid of my short hedges? Is
yeah,
it 10% back up, 20% back up? How
yeah,
do I know when it's what percentage is it safe to assume,
yeah.
okay, this is real, I have a green light?
Yeah, this is the hardest part in my view. This is the source of my recurring error, which is to sell my shorts too soon because I'm scared of short profits turning into losses. Okay, because then it would have been better to do nothing. I've been trying to be really clever, and all I've done is cost myself money. Genius, right? You've seen that book When Genius Fails, right? Or the Far Side cartoon called School for the Gifted, where the kids trying to push through the door and it swings the other way. Right? So you can get too clever with this stuff. Um, I have a couple of answers, and the first thing to say is it's not easy, but I'll tell you what I do, and this is not perfect, and other people will tell you better methods, but all I can tell you is what I do. The first thing is I try and constantly look at a more granular chart. Okay, so this here is, for instance, a 4-hour chart, and I'm in TradingView and I've switched on extended trading hours. So uh, normally it's just that, normal trading hours. If you switch on extended, you can see the full data in the mornings and the evenings outside of normal hours. And in a correction, usually what I'm looking for is a full ABC correction from the highs. So what I want to see is a down move, a material up move, another down move, and then I want to see some bottoming out and a so-called 1-2 setup. I'll explain what that means. So let's just for the sake of argument, say that we thought the current sell-off was done, right? Let's say we've had a 5% correction in the S&P, a 10% correction in the Nasdaq. Let's say it's done. Well, what would that look like? Here's the high on the 16th of July, and here's the low today. Well, first of all, have we had 5 waves down? And again, I can hear Fred, who's a much more sophisticated Elliott wave analyst than me, much better purist. I can hear him yelling at me, but I'm going to ignore Fred in my head. I'm just going to draw this anyway. So I would say, well, look, here's a 1 and a 2 and a 3 and a 4 and a 5. Does that breach any rules? No. Third wave isn't the shortest. Fifth wave's a bit long, but okay, I'm going to call that 5 waves down. Okay. So I'm going to say, well, okay, is that right? Is this simply, remember I'm looking for an ABC correction, is that simply wave A, in which case I'm going to see a wave B, and then a wave C like that? Or are we done? And of course, one doesn't know. This is the hard part. Okay. Let's sketch out what an ABC correction might look like for a minute. Let me just get rid of this so we can see more clearly. You can measure these things too. A B wave, you can measure as a retracement of the A wave. So you can say, well, a B wave, where might it stop? It might stop at the 61.8 retrace, or let's say the 78.6 retrace there. And then that's our counter trend rally. And then we might see a C wave down. Where will a C wave stop? Well, it often stops at something called C equals A, which is what it says it is, which is the share price change here from 0.0 down to A is the same as the share price change from B down to C. So C equals A is a common termination point. So my starting point with the current correction is, I think what we're going to see next is a B wave up. And a B wave, I think, is a really tricky, fiddly, evil thing, because it is designed to do one thing only, which is for any large money manager that was dumb enough to miss the top, it gives them a go around, right? it gives them an ability to get out back up here at, maybe a few points below the top when their cleverer friends were already selling up here. But the effect of a B wave is it convinces anyone who isn't concentrating that, oh, well, the sell-off is done. And, yippee, that was it. Off the races. In we go. Oh, what's this now? Why is it still there? Oh, my God, what's happening now? Right? And then then everyone starts selling down here when they should have been selling up here. And that's how big money takes money off other people. So right now, the question as to are we done, it goes like this. Say this is a low here, and there's some evidence that it is, which I'll show you in a minute. If it starts rallying tomorrow, is this a B wave or is this a real reset? Well, for me, I can count, I think, 5 waves down here, not 3. So I think this is an A wave down, and therefore I think a B wave is coming next. I can't see a 3-wave pattern there. I mean, maybe you could say that's 1, 2, 3, maybe, but that looks like a 5-wave pattern to me. Again, this is all judgment. You're guessing. If this is a B wave, then price will start to peter out somewhere between, let's draw it. Probably price will start to peter out somewhere in this green box here, probably. It's possible it does happen for B waves to go up above the previous start, but let's not worry about that at the moment. Probably price will peter out here and it will roll over it. So if I went long down here, let's take a really simple example. Let's say I've sold all my shorts, which as it happens I have personally. I've sold all my shorts because I think we're going to reverse upwards. If it keeps going down, oops, I was wrong, I've got to buy some more shorts. Okay, that's easy. Again, the key with this method is never assume you're right. In fact, it's always better to assume you're wrong. Because if you think you're right and the market's going against you, you're going to just keep telling yourself you're right, all the while you're burning money. Okay. So if it keeps going down, simple, add shorts and wait. If it starts going up, as I'm positioned for this personally right now, so I have all the longs I want. I might add to longs on the way up, maybe. But what I'm going to be watching for is price to start to fail way before it reclaims this all-time high. If we go straight to an all-time high, well, that was great. That was the whole correction. This isn't a B wave. It's off to the races. If price starts to peter out up here, then what I think is, because I know what's coming next. It's a C wave, and a C wave is going to go below the bottom of this A wave, and that's going to freak everybody out, and that's going to feel like the end of the world. In fact, sometimes a C wave will put in a 1.618A. In other words, you take the share price change of the A wave, multiply by 1.618, start at the B, and you end up, down here. That really freaks people out. So if price starts to peter out up here, that's when I think, yikes, hedge, right? And maybe over hedge if I'm feeling brave. I don't often feel that brave with shorts, but hedge. If I'm wrong, well, I should have plenty of locked-in profit in the longs, and if I burn some profit on the shorts for a bit while it keeps going up and I have to sell them at a small loss, okay, I can deal with that. But price starts to peter out here, yikes. Let's run for safety. And if I wasn't hedging, I was just going to cash, I'd go to cash once price started to peter out, because you can always get back into a long, right? You must never be afraid of being out for long. That's the sort of zoomed out method. The next thing I look at is I go, okay, well, let's zoom in, right? Really zoom in. So let's look at a 5-minute chart, for instance. So I was doing this later in the last half of today in our Slack chat room. You might have seen it. So this is the S&P. This is a 5-minute chart. And what I was doing was going, okay, so let's just get rid of all drawings. There we go. This is the low of the day today. This was struck just after 10 o'clock Eastern. And I look at that. Not coincidentally, see, none of this is real, right? This is all managed very carefully. There you go. So the low of the day to the dollar, pretty much to the cent, was revisited at the close. That's perfect. Okay. I mean, you got to think that's funny. What I was doing this afternoon was going, okay, I wonder if this here is a reversal. Because look, if you measure it, I did this all day for fun. Slightly worrying. Okay, let's just make those lines a bit bigger. Okay. So here's the low of the day today. Here's the high. Let's measure the retracements. Now you can see it thinks about stopping at the 0.5 retracement. It bounces there, but it fails. It thinks about respecting the 61.8 retrace, goes a bit below, but then it rips up, and you think, okay, well, look at that V shape there, right? Is that a reversal? Because look, it's sharp enough, down, bang. Now we're zoomed in, so there's, the price changes here are small, but nonetheless, that's a bang, bang, V shape. So is that a reversal? Could be, but no, it hits the 38.2 to the dollar, and it sells off again. And then what I was looking at is, okay, will it respect the 78.6 here? Answer, no, shot through it. My next question was, will it respect the 88.6? No, bang, shot through it. And look, revisited the low of the day and then started to move up. So the question now is, okay, well, look, it didn't make a new low on the day. Okay, it retested that low. And so what you conclude is today in the SPY, there were no willing sellers below 537.46. The market tried once, it tried again.
Right.
Nobody wanted to sell below that
Right.
price. And so is this a move up now? Could be. And if we zoom in again, sorry this is so boring. It is really boring.
No,
But,
it's not boring. It's very interesting.
okay, so we zoom in
Because you
again.
could say,
Now we're on a 1 minute chart. And so the question is are we pulling in a move up? Now remember, people talk about fractal market patterns. I don't quite believe in that. Fractals are, perfect replicas at smaller and smaller feature sizes. I don't think they're quite fractals, but certainly there are similar shapes of pattern in markets. So, well, what do we have here? Measure it, right? So my answer with markets is whenever I'm sat there thinking, I don't know what's going on, which is 14 times a day, I then sort of smack myself around the head and say, well, measure it, idiot, because measuring it is always, always the best thing to do. So what's this done? This is put in from the retest of today's low. It went up, that's a wave one, down a wave two. It tested the 61.8 here, held it, tested it again here, held it, tested it again here. Now in a wave three up. That bar there is peaked just about over that wave one high, and it's thinking about moving up. So far, in after hours, so this is data that most people don't bother to watch, but it is important. So far, we've got a 1, 2, and what looks like a developing 3, maybe a 4 and a 5. And maybe, if we zoom out again to a 5-minute chart, maybe that is your V-shaped recovery. I don't know. So the evidence as to why we might have a reversal now is because one, where's my right one? We might have. Sorry, Ron. We might be starting. I've lost the drawing, but we might be starting that B wave up that we just talked about. So at a sort of 4-hour, 1-day level of Zoom, we might be starting a B wave. At the 5-minute level, we saw a double retest of the day's lows, which were held at both points. In other words, no willing sellers below here. And then at the 1-minute level, we can see the market trying to rally. So what does this say? It says we might have a reversal, maybe. When would you decide that we don't have a reversal? My answer would be if it breaks below the low that was tested twice today.
yes, right.
So that's here and here. Market breaks below there, we're not in a reversal. And then for me
Here.
personally, I'll think, oops, I better wind on some shorts again. So this is, it isn't easy. And I personally, I couldn't do this level of work if I, had a real job. And so spotting it to this accuracy is really difficult. So if you're busy all day, you can't look at 1 minute charts. It's impossible. But what you can do is look at charts at the end of the day, right? You can look at the start when you go to work, and you look at the end when you come home from work, and you can see, well, what's the movement on that day? It's probably, if you've got something to do that doesn't involve staring at a screen all day, you probably don't want massive amounts of leverage, because when those things go against you, they can hurt you. You probably want less aggressive instruments. But it doesn't mean that you can't protect yourself from downturns, either by going to cash or by hedging. You've just got to choose your risk level that suits how much time can you spend on this in the day. And frankly, is this interesting to you? I mean, I actually like doing this stuff, but if you'd rather be outside, or have hobbies, or talk to people or something, weird stuff like that, then it's more difficult to do this.
No, it is interesting because it allows you, well, the quote by Warren Buffett, what you're doing is you can make intelligent decisions based on all these Fibonacci levels. Risk comes from not knowing what you're doing, but what you're doing is knowing what you're doing. So you lower the risk. I just want to write down the 2 levels that were tested today so
Yeah,
I can
sure.
monitor what goes on tomorrow. So what dollar amount was that was tested twice?
Yeah, hang on a second, I'll call it up. Yeah, so it was at so about 10 a.m. Eastern today on SPY.
Uh-huh.
Was 537.50, let's call it, and that was tested again right at the close at 4 p.m. Eastern today.
About 537.
Yeah, so if
Okay,
you
good.
get a double bottom there, so if that's breached, there's more selling to be had.
Yep, good. That'll be a good guideline for tomorrow and beyond. Thanks, Alex.
Welcome. Great questions, Ron. Thank you. Okay, well, probably I've bored everyone silly, but this hedging thing is, to me, is a continuous learning curve. I would say I'm okay at it. Since I've started to do this, which has been in the last, I would say, 2 years, it's transformed my investing and trading results, because it used to be that when a bad thing happened, I knew enough to go to cash, but that was all really, and that's okay. I did okay with that. And I'm old, and I've lived through a few crises, and so you sort of learn to see them when they're coming, and you learn to just get out of the way a little bit. But this hedging and over-hedging method, which I learned during the 22 bear market, because I had a hard time sort of figuring out the answer to some of the questions that we've discussed on this call. I've started to use this, and it's made a transformational difference to my own investing and trading performance. So I think it's worth everyone working out how to manage risk using something like this. So just to go over, the number one thing is measure it, right? Measure market movements. Don't get caught up in the news. Don't get caught up in the narrative. Don't get caught up in whatever the hell's going on, CNBC or Twitter. None of that is there to help you. It's just a video game, right? It's just numbers, colors, bars on a chart, all it is. If you sat there going, I don't know what's going on, measure it. Draw a wave pattern or any other technical analysis pattern that you're comfortable with. I find this one works for me, but there's many other systems. And measure the moves. And within your technical analysis system, know whether that's a big move or a small move, right? So measure it. Don't sit there going, I don't know what's going on. The price will tell you what's going on. That's number one. Number two, work out how is it you want to manage risk. Do you want to go to cash? That's fine. Nothing wrong with that, because if you're wrong and you went to cash too soon, you can always go back in. That's the beauty of public securities. One thing I haven't really talked about, but it's in that note that you'll find on our website, is the method I've just talked about is great for liquid, institutionally traded securities. So this is great for SPY, QQQ, DIA. It works for Apple, Microsoft, any of those things. It doesn't really work for weird and wacky stuff, right? Very esoteric stocks or ETFs, it doesn't really work. You want something that's institutionally traded and therefore predictable according to the systems that we've talked about. So ignore the news, measure everything, learn to know what an up to down reversal looks like, learn to look what a down to up reversal looks like, and always assume that you're going to be wrong and know what to do when you're wrong. And the answer is, don't get caught rabbit in the headlights, hoping it goes your way. Do something about it. So if you went long and you shouldn't have done, hedge it, get back to flat. If you went short and you shouldn't have done, hedge it, get back to flat. If you're hedged, if you're hedged 1-to-1, then you've suspended time. And the great thing about suspending time is you get to think. If you've suspended time, then the market can be going nuts in one direction or another. Your account is going nowhere. And whilst you might not be making money, you're not losing money. Because losing money means you can't think straight. All you're doing is looking at the red sprawling up and thinking, oh my God, I'm an idiot. How did I do it? How did I let this happen? Oh my God, will it change around soon? And that's not an investing strategy. That's a rabbit in the headlight strategy. If you hedge, you pin your account and you can think. Go for a walk. Don't even look at the screen for 3 days. Doesn't matter. You're not losing money. You can always make money. And if you're not losing money, you've got a clear head. So that's the sort of final point, really, which is when wrong, hedge, pin it, suspend time, buy yourself time, then you can step back, think calmly, and decide what to do. Okay, end of boring lecture. Hopefully that's been useful. This is I would say that most awful thing, a lifelong journey of learning. I'm just vomit now. I've said that, but it's difficult, not easy. But I found that personally that the more time and effort you put into this, the better you get at it. You have plenty of mistakes, like anything difficult, but it pays great dividends in the end. So hopefully people will put some work into it. Okay, everyone, we're way over time. Thanks very much for showing up today. The recording will be live in a couple of hours once it's upscaled to HD. As always, any questions, hit me up in the chat room later on. Thanks, everyone. Talk to you all soon.